Hello, everybody. This is Craig Garcia with Capital Partners Mortgage Services, and welcome to today's South Florida Mortgage Report. I am flying solo today. Bill May could not attend, but we are going to talk today on today's episode. We're going to talk about mortgage rates. We are going to talk about this new bill that just got signed regarding trigger leads and what that is for those folks and for those people who want to not have to wait to get the protections that the trigger lead bill is actually going to provide come in March. And then we're going to talk about a recent transaction that had a couple of lessons in there for us that is pretty interesting regarding credit and a little tenacity. Anyway, we'll start with mortgage rates. So the Freddie Mac mortgage survey for the week last week ended up at 6.5% on mortgage rates. And so that's a national average. And it's probably, I think we're seeing people get even lower quotes than that right now in some cases. So the Friday, we had the jobs report, the non-farms payroll report came out. And again, just like the previous months, it was weaker than expected. And so this opened the door for more talk and more thought that, hey, the Fed is going to lower rates here coming soon. And so the bond market responded well, and rates improved. And so we try to tell everybody, rates, we like the term rates don't wait for the Fed. If the market, and the long-term rates and mortgage rates are set by the bond market participants. And so if they think that the Fed is going to lower rates in the future, they'll start acting accordingly now, and you can see mortgage rates improve before the Fed takes any action. And so we've had a nice little run here where rates have been trending downwards, which is very helpful for anybody who's looking to buy or potentially refinance. So, but just because once you hear that the Fed has actually lowered the short-term rate, it doesn't necessarily mean that that's going to equate to mortgage rates coming down. And we have situations we've seen certainly in the past where people are waiting for this announcement. They hear the Fed lowered rates, and oh, lo and behold, mortgage rates went up that day. It can happen because they can come out and say, hey, we lowered rates 0.25% today, but we feel like we're not going to have to do that again for quite a while, or they could say, hey, we didn't lower rates at all today. And they could say, but we see a lot more aggressive rate cuts coming in the future. And you'd actually see rates get better in that case. It's more about what the bond market thinks they're going to be doing in the future. So anyway, so the time right now is pretty good. So definitely take a look at that. So between what's happening with sellers in the market, rates are getting better. A lot of good things if you're a buyer. You've got property selection, you can negotiate. Rates have been improving. We've been hearing about insurance rates improving. So the market for buyers is improving, and that's a good thing. So anyway, so that's about rates. The next thing that was in the news was this news about the trigger lead bill that just got signed into law. And so if you don't know what a trigger lead is, trigger leads are where when somebody applies for mortgage credit, okay, and I'm just going to talk about mortgage credit for our purposes, the bureaus, Equifax, Experian, TransUnion, would have basically taken that as an opportunity. Hey, we know this person's inquiring about a mortgage and we want to make a buck, right? Is basically what happens. And they go sell that customer's information to anybody, any other mortgage lender out there that's looking for somebody to call and solicit. And they will sell that information to as many people as possible, frankly. And so that's called a trigger lead. So you're trying to apply for a mortgage, see what you can get approved for. And then suddenly what can happen in some of these cases is you suddenly start getting, in some cases, it's hundreds of phone calls. It's an obscene amount of phone calls that you can get from mortgage companies and loan officers soliciting you for business from all over the country. It can happen. And unfortunately, just as in any type of business, you have some people that are marketing and they're a little bit less virtuous than others. And so sometimes they will call and make it actually sound like they are calling from the company that you may have already applied with, which is a little deceptive. But regardless, you get bombarded with calls. And so this is because it can be very disruptive for somebody who is not looking to have to have to deal with all that incoming noise. So this law is going to prevent that from happening to a large degree. It's not going to prevent all trigger leads from happening. But basically the rule is if you have a current financial relationship with an entity, they may still be entitled to get your information and the fact that you applied for a mortgage in this case. So if you already have a mortgage with a company, they may still be notified that you've applied for a mortgage with somebody else, and you might get a call from whoever your current mortgage company is. Or if you've got a depository relationship with somebody at a bank, um, the bank may also, because you have an existing financial relationship with them, they may also get your information as well. And also, if you've happened to have explicitly opted in to be solicited for that type of thing from other marketers. But I think it's going to weed out a lot of that stuff. Now, this bill does not take effect until March of 2026. So if you're hearing about this and you go, man, I don't want to have 300 phone calls hit me because I want to get pre-approved for a mortgage. Well, there's something you can do today. So there's a website that's set up, and I would encourage most people to do this because this doesn't happen just in the mortgage business, although this is what we focus on. But if you want to not be part of the information that gets sold when you apply for things, there's a website that's set up by the bureaus where you can opt out, and it's optoutprescreen.com, optoutprescreen.com. I'll put the link in the show notes, and you can go there and you can opt out. There's a way you can opt out for 5 years. I think there might be a way you can opt out permanently, but essentially you can say, hey, listen, I don't want to get solicited by anybody. And you can get taken off of that list. So that is something you can do today, and I'd recommend that people do it. Nobody needs any more phone calls, unsolicited phone calls in your life, I would think. So anyway, that's the story with trigger leads. And then the last thing I wanted to talk about today was, a couple lessons that we learned from a client interaction where we had an initial conversation with somebody that we pre-approved, and then they went out and we actually missed something on the pre-approval. So this customer was looking for a particular type of loan, happens to be an FHA loan, and everything looked good on the credit. The one thing that we missed was that they had a couple of disputed accounts on the credit report, and one of them triggers some extra scrutiny on a loan file. So what happened with this customer is they went out and they actually went and met with a builder. They wanted to buy this new construction property, and the people on site there said, hey, listen, you got to get pre-approved by us. We're part of the builder. And they ended up indicating to them, hey, listen, whoever you spoke to, they made a mistake and you cannot get mortgage financing, and you definitely cannot buy this house. And so they were upset, called us back. And we went back and looked, and it was definitely an error, but it was definitely overcomable. And so there was some things that we had to do to help make that piece of credit become not impactful on the borrower. And so we were able to kind of work through that. And the interesting piece where the tenacity comes in is there was I think there was something going on where there was some type of medical issue that kept getting that they were in the process of being in a dispute about. And so we were playing whack-a-mole a little bit with this credit because we would get the one item resolved and then something new would come up. So sometimes when we're dealing with customers, we have to get their credit score changed quickly. Sometimes people can qualify for a better loan because they just by altering the makeup of what they owe on some of their revolving debt. Or sometimes they have something that, in this case, we also are able to make some quick changes to people's credit because they had something in dispute that was actually hurting their chances for approval. So anyhow, what happened was as we cleaned up one issue, another thing popped up and we had to go back and clean that up. And that happened a couple times, but we kept at it. The customer was working with us and we were able to take somebody that had been told, hey, by the builder, you will not buy this house. And we were able to help them close on the house. So you definitely have to be resourceful, and so we learned a couple things during that process. But I thought it was a good story about taking something that potentially was negative, turning it around. And now, these are some very, very grateful, happy homeowners. So anyway, that's really all we've got for today. Wanted to just give you a brief, summary of what's going on in the market, what we were seeing, and we will catch you on the next episode. But thanks for tuning in. Please like, subscribe, and we will talk to you next time. Thanks.